promise, we now have Kunal Bothra in the studios with us to talk exactly about what that SEBI consultation paper was all about. Why was it firstly, why did the SEBI come out with it firstly, and what does it mean? So firstly, Kunal, let me ask you about the question. Why do you think that this consultation paper has come about? We've heard a lot of commentary talking about what is exactly happening in the F&O market. There's a frenzy, is what they're saying. We've also had commentaries from Finance Minister, Finance Secretary as well, isn't it?
Absolutely, Cheryl. And you know, so I read the entire consultation paper, and the outcome which has come out from the consultation paper is very important. And there's one word which is very important, which is speculative hyperactivity. So the entire measure which we'll be discussing is that how to curb and curtail the speculative hyperactivity which is going on in the index options front. So we look at few of the slides now. The first one, for example, the thesis of the entire report is that there's been a major rise in the F&O trading which has happened over the last 6 to 7 years. So from FY 2018, the index options turnover was just about 4.5, and that's risen up to almost 138. So you can see that this is a 30x jump in the index options turnover itself, even though the index has moved from 10,000 levels to 24,000 odd mark, which is a 2x jump in the index. This compared to the stock options, the stock futures, the index futures, the jump over here is exponentially high, and that's generally indicated that there's been more speculative hyperactivity, and that's the word which the SEBI consultation paper has mentioned a couple of times. Now, what are the proposals which have been at play in the consultation paper? The first and the most important is rationalization of strike prices for options. Now, what earlier used to happen is that there were 35 strikes at the above in the money as well as out of the money for Nifty, and 45 strikes plus minus for Bank Nifty. Now, this generally indicated that there's been more illiquid strikes, because when you go beyond a certain strike price like a 4%, 5% range, those strikes, they actually become illiquid, and that's why there is no reason for having those illiquid strikes. So the proposal is now to curtail this to almost 50 strikes or not more than 50 strikes for any given individual contract. And this could probably also curtail that the range which was 7% to 8% earlier will now get curtailed to 4% broadly for the index. So both on the Nifty as well as on the Bank Nifty. Then the second and the most important part is upfront collections of options premium. So for traders who've been trading into F&O side, they already know that options, the premium was getting collected on the futures side, as well as the margin was getting collected on the futures as well as on the sell side of the options. But for the options premium, there was no stipulation as such to try and collect the entire premium. But now the consultation paper says that the aim is to try and go for a classic stipulation where you collect the options premium even on the buying side of options. The third and again interesting strategy, because I believe not many people know that there has been a calendar spread benefit which happens. So when there is there's an offsetting strategy which is there when you have a calendar position strategy. Now that offsetting because of the calendar spread or the margin requirements, which is generally very lower when you try and have a calendar spread, that drops down. So rather than having a normal margin requirement for 2 positions, and that too when you're rolling it over to the away series, so which means 3 expiries beyond the current series, the liquidity parameters are very low, and I think that generally indicates that the calendar spread strategy has low margin requirements, which should not be the case, because as and how you go away into the expiries, the risk and the volatility increases. So that's why to curb this liquidity risk, they've indicated to try and remove this calendar spread strategy. Intraday monitoring of position limits. This is again very important, because earlier the current practice was that the limits were monitored during by the end of the day. Now there is going to be intraday monitoring. So if, for example, if there is a certain limit which you have in your account, then the positions could be taken only to the size of the limit and the margin which you have deposited in that account, and it will not be calculated post or the end of the day. The fifth, and again a very interesting kind of consultation which is there, is to increase the minimum contract size. Now we all know that the index strikes or the index size was around 5 lakhs to 7 lakhs on a broader basis. So if you calculate 25,000 Nifty and with the lot size, the current size was around 6.5 odd lakhs. Now that will gradually be increased to 15 to 20 lakhs, and then beyond the next 6 months, the average size would be 20 to 30 lakhs. This, of course, is the aim of doing this is to curb the higher amount of risk, because there has been higher amount of activity because of the low margin requirements from an index futures perspective, and that I think would probably be curtailed significantly. And the sixth portion is that you have to rationalize weekly index products. Now we all know that there has been so many index expiries which happen on a weekly basis, right from Monday towards Friday. Now there is no need of having so many number of weekly index expiries on that on every particular week. So that has to be curtailed and the number has to be brought down, even though there is no specific mandate or the indication is given as to which indices would be impacted in this particular consultation proposal. And the last and the most important is that there has to be an increase in the margin near the contract expiry. Now the key highlight over here is that SEBI consultation paper says that the volatility which happens on the expiry day or very close to the expiry day is more speculative, and it is not driven by market forces as such. And to bring that down, what you need to do is have a volatile kind of a margin. So the more you move closer to the expiry, the margin actually has to increase rather than remaining normal. So this would also help curb the speculative activity. These are the proposals by SEBI in the consultation paper mentioned.
Absolutely. Looks like you had a very long evening, Kunal, isn't it? The fact that you went through the entire consultation paper. But thank you so much for actually breaking down for all of our viewers, for explaining what the proposals are and what they likely are aimed at. Thank you so much for the exhaustive and yet detailed explainer on the SEBI consultation paper on F&O. Thank you so much, Kunal.